So, good morning, Dwight. Thank you so much for agreeing to speak to me today about mortgages and possibly early payoff mortgages. Before we get started, if you could just introduce yourself.
Sure. My name is Dwight Crawford. I'm the Vice President of Community Lending with Regions Bank in North and South Carolina, and I'm excited to be here. Thanks for inviting me, Sandra.
Thank you. Thank you. And so we have known each other for years.
Oh,
We
yeah.
got together, of course, in the real estate industry. We started with Charlotte Crown Realtors Association, have kept in contact. So just wanted to ask you some questions since you're one of the experts of mortgage lending.
Okay.
So many people, when we think about mortgages, we think about, 30-year mortgages, mortgages versus rent. And so I just wanted to, just have a quick conversation with you. What exactly is a mortgage payment?
Well, that's a great question. It seems like a very basic question, but it's an important one because a mortgage payment itself actually is comprised of four different components. It's the principal that you're going to be paying back on the loan, but you also are going to be paying the interest to the bank for that loan. And typically, you also will be paying the property taxes on the house and the insurance on the house. The banks typically would prefer that you're paying your taxes and your insurance on the house, and it's actually been quite convenient for a lot of homeowners because, especially with the rising property taxes right now, most places, especially in this area, the taxes are normally due at the end of the year, right before the
Mhm.
holidays. So it's always difficult for people to come up with thousands of dollars at one time when they also would like to provide a really exciting time for the holidays for their families. So this way, it breaks that payment up into the mortgage payment so they don't have to come up with that lump sum. Um,
Okay. Okay. So the four parts of the mortgage payment generally is the principal, the actual mortgage amount, the interest on that mortgage, the taxes, and then the insurance on the property, correct?
Correct.
Okay,
Yes.
so which is certainly different from a rent payment, but from a lending perspective, what's the difference, the true difference between a rent payment, someone who's leasing a property, and
Mhm.
then the mortgage payment itself?
Well, it's that itself is in the whole purpose of what we're doing. When you're renting, what you're doing is you are paying a mortgage, but unfortunately, it's not your mortgage; it's somebody else's mortgage.
Mm,
So what you're doing is you're paying to be able to occupy a space. The only thing that you're going to get in return for that payment is the ability to live there for the next 30 days. If you don't pay the next 30 days, you no longer have the ability to be there. With a mortgage, you're actually purchasing your home where you're building equity in that home. Now, what equity is the money that we receive, or that it's the wealth that we build as our home's mortgage gets smaller and smaller, and the amount of money that we have in that home gets larger and larger. I tell most people a home is, besides a place to live, is also our largest bank account because we
mm,
get to build
mm.
wealth as we pay that mortgage off. When you rent, all you're doing is you're contributing to somebody else's bank account.
Mm,
So there's a
okay,
very big difference. So
it
the
is.
question is, which account would you like to deposit in? Yours or
Right.
somebody else's?
Right. So here's the way I look at a mortgage. A mortgage is, like you said, it builds wealth as long as we continue to build our equity. But the
Mm-hmm.
beautiful thing about a mortgage is that it can be paid off. I've never known anybody to be able to pay off a rent, because
No,
once you stop renting, you don't have the money and you don't have the property that you were living in. But that's a totally different conversation we'll have.
yes, yes.
So,
You have nothing to show for it except for
yeah,
the money you spent.
right, right. So, how long are mortgages? Like the length of mortgages? I know most lenders start out with like a 30-year, or they discuss a 30-year mortgages, but let's talk about the length of how long a mortgage can be.
Okay. Well, the way that it works out now is that the most banks, especially if you're a first time home buyer or if you're a buyer, they're going to talk to you about a 30-year term. Purpose of the 30-year term is that, of course, it will give you the smallest monthly payments because the payments are dragged out for a 30-year period. That's the upside to a 30-year loan. The downside is that you're going to be paying on it for the next 30 years. There's
Mm,
also, of course, we also talk a lot about 15-year terms. It's half of the time, of course, so you're going to get your home paid off faster. But in doing that, you're going to be paying much more money on a monthly basis in order to eliminate that debt. Now, I'm going to give you guys, everybody, a secret. Don't tell anybody except everybody you know that you do not
Okay.
have to be restricted to just a 50-year or a 30-year mortgage. And this is incredibly important for especially if you currently own your because let's say that you buy your house today and the interest rates are, in the sixes, depending on your credit, sometimes sevens. And this is not the best rates that are out there, historically. So now a few years down the road, the interest rates start to go down and you say, well, I would like to take advantage of it. So people say, well, I do get to spend less money because my interest rate is lower, but I have to go all the way back out to a 30-year term. So it means I'm starting it all over again. Well, this is not necessarily true. Most banks, if you ask, can do whatever term you like. So if you've been in the house for 3 years, you don't need to start all over again. You can do a 27-year mortgage. And this way, you can stay where you are from a term perspective while still taking advantage of a lower rate environment and being able to cut the amount of money that you're spending on a monthly basis. So you get to save money short term and long term. So I think it's something that everybody should investigate if you have the opportunity. And even when you're buying your, you don't necessarily have to stick to a 30-year term unless there's some sort of requirement of that program.
Okay. Wow. Okay. So can all loans be refinanced or remodified to where, say, for instance, someone does have a 30-year loan
Mhm.
and they have been in the house for 5 years. And so what you're saying is that they can take out a 25-year loan, correct?
Absolutely.
If they wanted to, could they make it shorter? So could they do like a 20-year loan or
Absolutely.
any? Okay.
Yeah, and that's a great thing to do. You look at the numbers and say, well, the rates are down. There's a lot of in that scenario, what typically happens is that you can probably end up chopping a few years off of the mortgage with a lower interest rate and still spend the same, if not lower, than what you're spending right now. It's the power of compound interest. It's
Okay.
amazing.
All right. So, especially if you have a lower interest rate, but paying the loan off early. So,
Mhm.
what are the pros and cons of paying a mortgage off?
Well, the number one is that it reduces the total amount of interest that you're paying over the life of the loan. The way that it works is that the amount of interest that you pay is based off of the money that you still owe. So if you borrow, let's say it's year one and you have a $300,000 home, the amount of interest that you're going to be paying is going to be based off of the $300,000 that you owe. But
Okay.
5 years, 10 years, 20 years down the road, that 300,000 gets reduced. That means, say, when you owe 250, you're only paying on the interest that you owe, 250,000. So by paying it off early, you're reducing the amount of money that you're going to be spending in interest, which can legitimately save you tens of thousands of dollars. The other
Okay.
thing that it does is it provides a financial freedom and peace of mind that is probably much more important than money. Having to know that that your income is now truly more income versus outgo, because it's very rare, especially in this market, that anybody who's purchasing a home today is not spending anywhere between 1,900 to 25 $3,000 a month just on their mortgage.
Yeah.
How does your life change without that bill every single
Right.
month?
Right.
That's $3,000 to your children's education. That's $3,000 that's now towards retirement. That's $3,000 that's now towards investments that you can now grow, that you no longer
Right.
have to pay. So
Right.
it's a big difference, and the tens of
Right.
thousands of dollars saved over that is immeasurable. It's amazing.
Okay. So far, number one, we can pay off a mortgage down to zero
Correct.
versus renting where you always have it.
Hmm.
We always have that monthly payment. Number two, it frees you up should you want to pay down your mortgage early. So, and so those are the pros. Any cons for paying the mortgage off
Absolutely.
early?
Great
Okay.
question. One of the biggest benefits of purchasing a home versus renting is you have tax deductions from the interest that you're paying on your mortgage. Once you pay off your mortgage, you no longer lose those deductions, which means that typically just between you and I, it's going to reduce your refund at the end of the year. The
Okay.
other thing that it does is that if you need to make sure that the loan that you have does not have any sort of prepayment penalties. There are loans out there, there's not too many, but there are certain loans out there that do come with a penalty for paying off early. So you might
Okay.
want to take a look at that as well. And the I think one of the biggest issue with paying it off early is that in order to pay off a mortgage early, you're going to either be paying extra per month, which is going to reduce your monthly liquidity, or you're going to take a large lump sum of money from savings or in different investments and pay that towards the mortgage. So the con to that could be the an increase in monthly spending or a decrease in your actual savings that's going to be needed in order to pay that off. But
Right.
again, there's a light at the end of that tunnel. Both of
Okay.
those can be easily regained by the elimination of that debt.
Right. Okay. And I was going to mention, in the short term, it is a reduction of savings because you're paying so much on your mortgage. But
Correct.
over the life of it, number one, you're saving interest because you're
Mm-hmm.
paying it off early, and you have your money once it's paid off. So
Correct.
I understand about the tax deductions. I understand, but at the end of the day, you have your funds. Okay.
That's it.
So okay. So let's talk about how to pay off a mortgage. I have heard you can pay off a mortgage by making a just a one-time payment per year on the
Mm-hmm.
principal, or you can do it when you get a lump sum of money, in a year, or you can do it monthly. Just paying so much money over the life. Now you're a homeowner. You're very savvy with mortgage lending. What do you recommend? What have you seen? What do you think are some of the best way to do it?
Yeah, it's this is going to be an individual answer because there's no two homeowners are the same, no situation is the same. So it would be done on an individual basis. And here's some of the ways that I would suggest that most people do this. Um, Now, there's a formal way where a lot of lenders will allow for an additional series of payments to be made that you're in a plan where you're in a plan that you will be making additional payments. What that does is it obligates you into a specific number, and you have to pay that every single month. And at the end of the term, you'll see that you've taken off whatever the amount of time is that you've already negotiated. It's 12 years or it's 15 years or what have you. It's a formal program that they have. I'm
Okay.
not a very big fan of these formal programs because I like to control my loan. I do not want my loan to be controlled by my bank. So what I do is I will figure it out. Now, the rule of thumb is that if you make one additional payment per year, depending on your interest, you'll be able to save anywhere between 7 to 15 years on the mortgage, depending
Wow.
on how
Okay.
much additional money you put down
Okay.
and depending on the interest. Now, the for budgeting purposes, sometimes it's not very easy. Remember, we talked about anywhere up to $3,000 a month, depending on your mortgage payment or how much you've purchased. So for a lot of people, coming up with an extra $3,000, $1,800, whatever that number might be a little bit difficult. But here's what I will tell that same person. If your principal and interest payment is $3,000 and you divide that up by 12, that's only $250 per month. So which is easier for you and your family? Is it easier to come up with $250 a month, or is it easier for you to come up with $3,000 per year? It really just
Mm,
depends on your budget.
right.
Now, I know a lot of families, what they do, remember I mentioned that tax deduction thing. What they do is in April, they file their taxes and whatever their refund is, they'll take that money and give that back and pay that towards the principal of the loan.
Right. Okay.
Remember, you're only paying interest on what you owe, not what you borrow. So if
Right.
in April I owe $250,000, but I just got a $3,000 refund, well, now I'm going to reduce my what I owe by $3,000, and my interest is going to be reduced. So
Right.
it's a
Okay.
great way of doing it. Just a little extra will bring you a long way.
Okay. And even if a $3,000 mortgage over the year broken down $250, if someone can do that, great. Is it worth making just a $25 per month, maybe $50 per month, just a little extra? I mean, it seems like it would make a difference because we're looking over the life of the loan. But is that really worth it? Would you recommend that small of amount of just paying off the principal? in addition
Absolutely.
to the regular mortgage?
Yes, whatever extra that you have, that because remember I said it's on an individual basis. Some families
Right.
might have an extra $3,000 to pay. Some might only have $250 to pay. But if you only have $25 to pay, it does add up
Okay.
because $25 here, $25 here, $25 here, it will reduce what you borrow. I'm going to try
Right.
to pull up an example and see if I can show you real world numbers of
Okay.
something that might make a difference. If I have today a $300,000 home, and I'm at an interest rate of 6.5, the principal and interest payment is approximately $1,896 a month.
Okay.
And if I added just $100 to that per month, making my payment $1,996, I'm kind of curious to figure out how quickly can I pay that home off. Same loan amount, $300,000, and my payment instead of 1896 is 1996. Instead of paying that off in 30 years, what would end up happening is that it would be paid off in 311 months, which would be 25.9 years.
Wow.
Now,
Okay.
that's huge because here's what I would do with that number. 25.9 years is 311 months. So 311 months versus 360 months, which is 30 years, what you would actually save yourself, let's see, 360 minus 311 is 49 months. Now, 49
Wow.
months, your original payment was $1,896. So that means that, let's see, you would actually end up saving yourself over $77,000 in interest
Wow.
payments.
Wow. And
That is a,
time.
what's that?
And time.
Yeah, a lot of time. So the
Yeah.
big question that I have to ask everybody, who do you think could use that money more? The bank that you've been paying or your own family?
Right.
And I think my family can definitely use $77,000, a heck of a lot more than some large bank institution.
For sure. For sure. Wow. That is awesome. Okay. So I am the homeowner. My
Yes.
payment is 1896 per month.
Hmm.
I am now going to pay $100 more per month.
Yep.
How do I do that? Like what is the application of actually paying that? Because even if I pay online, if I write a check, if it's an automatic deduction, is the total $100 going toward the principal payoff? Should I do something separate? Like, how can I apply this?
That is a great question because the intention might not end up giving the right results if it's not executed correctly.
Okay.
And because here's what
Now
can
help us
happen.
execute.
What's that?
Help us execute.
Well, let's execute. Here's the thing. If you make $100 a month payment and somebody opens it up and they're like, "Well, what do you want to do?" There's two things you can do with extra money. You can put it towards the principal, or I can apply it to next month's payment. If I apply it to next month's payment, it's not reducing the amount of money that I owe. It's not going to do what we want it to do. It's just being applied to next month. So what I'd suggest to everybody is that for most places when you're making a payment online, there's typically a box that says paid towards principal. Check that box, put whatever amount in there. If you're old school and you're sending in a check, send in a separate check. And in the memo section of the check, I would write paid towards principal, because you want to make sure that this money is not going towards a monthly mortgage payment, that all you're doing on that 300,000 that I owe, I want to make sure that now I owe $299,900.
Okay.
That's what I should end up owing. So I don't want to just make my August mortgage payment, or I'm making my September mortgage payment early. That's not what I'm trying to do. I want to lower the payment. So paid towards principal should be in your payment somewhere. If you're doing it electronically, make sure it's in there and it shows that. And most banks, or if not all, have that option.
Okay. Perfect. Okay. Um, and plus so I'm giving a little bit more over the life of the loan, but in the end, I am giving myself $77,000
Correct.
back. Okay.
Because let
I
me
love
just
that.
explain what was that?
I love that.
Yeah, so do I. And I think understanding what this really means. Remember, in the beginning of our conversation, I said the payment is based on the principal, the interest, the taxes, and the insurance. That's nice, but what does it mean? Let's look at the same exact scenario. Remember that you've had that $300,000 house, your monthly payments, your principal and interest. We're going to leave taxes and insurance out of this. Just the principal and interest payment that you're obligating yourself every single month for the next 30 years is $1,896. $1,896 times 360 months means that you're paying $682,560 for the $300,000 that you borrow. So what that means is that in interest payments, you are spending $382,560. That is the number that we're looking to attack. You're paying twice the amount of money that the house costs because of interest. So how do we do that? How do we eliminate that? And that's the purpose of paying the principal down. Because keeping in mind, doing the same exact thing, paying the 1996, just that $100 difference. We're now paying 1996 times 360 months, 700 and well, sorry, that calculation is not going to make sense because you're not spending all of that for the next 30 years because so much more of that money is that $77,000 is being reduced
Right.
off of that $600,000 that we're doing. So
Okay.
you've saved yourself $77,000 off of a potential $600,000 in interest that you're paying.
Got it.
That's why we're doing this.
Okay. Okay. And who wouldn't want to do that? I mean, who wouldn't want to get, number one, get rid of the debt quicker, sooner, free yourself up and just have this weight of debt off of you. Although it's for a great purpose. I mean, it's putting a roof over your head.
Sure.
But to give yourself back that money, that's awesome. So, any other tips, tricks, anything else you think that we should know about paying off our mortgages early?
Well, the thing that I would definitely say is that banks don't typically want you to do this. They don't. And the reason why I just told you, they were making $600,000 off of us. And all you were doing is just buying a
That's
house and living
yeah,
there. That's
yeah,
a big number.
yeah.
So here's the thing. Your best interest, our best interest as a homeowner has to be the responsibility of us. The bank they were kind enough to lend us $300,000. Doesn't necessarily mean that they're our friends. They're in business to be in business, to make money. And interest is the way that banks do it. So there's nothing wrong with playing the game. The game is very simple. They have something that we need. They have 300. I don't have an extra $300,000 laying around. They do.
Right.
So we will take their $300, but we can take it on our own terms. The 30 years, something on paper. The $1,800 is something on paper. Control our destiny, control our homes. Just because they're saying that I have to pay 1,800, there's nobody saying that I only have to pay 1,800. Most
Mm,
banks right now, it's illegal for most loans to have prepayment penalties and be considered to be a conventional type loan. If it has a prepayment penalty, it's probably not. It means that it's one of those specialty loans that a lot of banks don't do anymore. No income check loans, no asset check loans, where there's a lot more risk and you're not federally insured. If you're doing a federally insured loan, you do not have a prepayment penalty. No
okay.
banks allowed. So
Okay.
do what needs to be done for the protection of your family and to save as much money as humanly possible. Don't give away money because they were kind enough to give you money. Um, Pay your family, pay yourself first. The way you do
Okay.
that, the elimination of debt. All right.
Awesome. Awesome. I love that. Love that. And yes, they gave us money, but they gave us money with interest. So, okay.
A lot of
Um,
interest.
so right. So for people who are very interested that want to talk more about mortgage payoff, just home buying mortgages, how can they get in contact with you? I'll put your information on my down in the link for people. But for right now, how can people get in contact with
Well, the two easiest ways of reaching me is my cell phone. It's my work phone. I'm normally available Monday through Fridays from 9 in the morning till 6 p.m. Anytime after that is dedicated to my family and to the paperwork that needs to be done to get people into homes. My cell phone number is 980-875-8334. or it can always be, you can always shoot me a quick email at dwight.crawford@regions, that's with an S, REGIONS.com. And I'd love to
Great.
talk to you, anybody, to answer any questions that you might have about mortgages or down payment assistance or home ownership or whatever it is that you might be looking for.
Okay, great. I really appreciate it. And Dwight, it is always great to talk to you. It's always great to talk to you. We will do this again. But thank you so much for giving us information about paying off the mortgage early. I appreciate it.
It's so my pleasure. I enjoyed every moment.
Great. Thanks.